How would you like to save money by getting rid of your PMI? First of all, what is PMI? Why do you need it? And how do you get rid of it? Well, that's what we're going to be talking about today. This is Monday Mornings with Mark. Hi, I'm your host, Mark J. Schmidt of RE/MAX Country and MoveMeMark.com, where I help you get the most out of the real estate market and your home. If you're new here, be sure to like this video, hit that subscribe button, and make sure you hit that bell so you don't miss out. So recently a relative reached out to me and she said, listen, my husband and I were looking to save some money. Our property taxes just went up and, we understand that, we've been paying PMI. Can we get rid of it? Do we have to keep paying this PMI? Had a real nice talk with her and told her exactly what she could do. And now I'm going to tell you what I told her so she could start saving money every month. So first of all, what is PMI? PMI is private mortgage insurance. And the reason you need it is because PMI is required anytime you take out a conventional loan and you put less than 20% down when you purchase it. That PMI, that private mortgage insurance, it doesn't actually go to benefit you. It actually goes to protect the lender in the event that you should default on your loan. It basically makes up the difference between whatever you put down and getting you to that 20% equity in the house. Now, the cost of PMI can vary based on how much money you're putting down on your home and what kind of credit rating you have. But typically, you can expect to pay anywhere from 0.4% to 2.25% of the mortgage annually in PMI. And it's usually included in your monthly payment. So to give you an example, let's say you took out a loan for $200,000 and your PMI was 1%. You would be paying $2,000 annually in private mortgage insurance. And really, it would just be added to your monthly payment, so you'd be paying an additional $166 a month. Now remember what I said up front. PMI is only for conventional loans. If you're taking out an FHA loan, FHA loans have something different. There's two things you have to pay with FHA loans: upfront mortgage insurance and what's known as MIP, mortgage insurance premiums. Now, FHA loans work a little differently than conventional loans. So basically, when you have an FHA loan, if you put less than 10% down on your home, you can never get rid of the MIP, the mortgage insurance premiums. If you put over 10% down on your home when buying with an FHA loan, you can have it taken off after 11 years. But once again, if you put less than 10% down on an FHA loan, you have to put a minimum of 3.5% down, you're going to have that MIP for the life of the loan. Now I'm going to share with you a way that you can actually get rid of the MIP on an FHA loan, but first, let's talk about how to get rid of PMI on a conventional loan. So first, your PMI can automatically be taken off your loan once your loan is scheduled to hit 78% of the original value of your home. Basically, it means that you need to have 22% equity in your home for that PMI to automatically be taken off. Now, the second way you can get PMI taken off is by actually paying down the mortgage until you get to that 20% equity level. Now, in that regard, it wouldn't automatically come off. You would have to reach out to your lender and tell them, hey, I just paid my balance down so that I now have 20% equity in my house. I'd like you to remove the PMI. Now, there's a third thing you can do, which is basically you don't always have to pay down the balance of your home. What you can do is you can actually have your home increase in value. So if the market is such that your home is going up in value, you can tell your bank, listen, the value of my home went up. I would like the PMI removed. Now, as long as you have, once again, that 20% equity in your home, you should be fine. Your lender might require that you either have an appraisal done on your home, or at the very least send in some comparable sales from your neighborhood that show that your value has gone up. But that is another way that you can get the PMI taken off your home. You don't always have to pay it off. You can use market appreciation. Now, there is one more way that you can get rid of PMI if you have a conventional loan, or MIP if you have an FHA loan, and that is to refinance. Now, if you refinance, you can either have extra money that you can put down if you're not at that 20% level, or if your home, once again, has just appreciated in value due to the market rising, you can use that to show that you have 20% equity in your home. Really, you're going to want to run the numbers though, because if interest rates have come up, if you're looking at a different interest rate than what you started with, it might not make sense to do that. You might just want to stay with what you've got. So whether you decide to pay extra on your mortgage to get that 20% equity or use market appreciation to get that 20% equity, as you can see, there are a number of things you can do to get that PMI taken off and start putting more money in your pocket. And let me give you a little bonus here. Once you get that PMI taken off, keep making that extra payment to your mortgage. That'll go to your principal and you will pay your mortgage off faster than if you just put that money in your pocket. But if you do need to put that money in your pocket, that's fine too. The important thing is that you're not spending money that you don't need to spend. Now listen, if you have questions about getting the most out of your mortgage or buying or selling a home, there's a fantastic resource. It's my website. You can find me at www.MoveMeMark.com. Thanks so much for watching. If you missed our last episode, I've got it right here for you. And here's another episode that YouTube thinks you should watch. If you haven't subscribed yet, make sure you hit that circle and subscribe so you don't miss out. And I'll see you next time for more Monday Mornings with Mark. You have a great week.